Welcome to the Daily Gold University lesson number 2. In this lesson, I am going to talk about gold's relationship to the U.S. stock market. Let's get into it. Over very long periods, gold and commodity prices have an inverse relationship with the U.S. stock market. When gold and commodity prices are in a secular bull market, the U.S. stock market is in a secular bear market. Let me go back for a second. When gold and commodity prices are in a secular bull market, the U.S. stock market is in a secular bear market and vice versa. A secular bull market entails a market or asset consistently trending higher and making higher highs for over a decade. A secular bear market entails a long period in which a market or asset does not make or sustain higher highs. It typically entails a sideways trend for over a decade. However, over shorter periods, such as a few years, the relationship between these asset classes can take many forms. There have been multiple periods in which the stock market and hard assets have gained together, declined together, and trended in opposite ways. As a result, which is pertinent today, there are some periods in which the secular trend in hard assets and stocks overlap. In Figure 2.1, we plot and define the secular bull markets in stocks and commodities. We show the S&P 500 index and the CRB index, which in this chart is an equal weighted index of commodity prices. Most commodity price indices today are distorted by extreme weightings of energy commodities. The boxes highlight secular bull markets, and BO signals a breakout. As we can see, stocks and commodities take turns. The economic reason for that is that rising commodity prices signal inflation. When inflation rises and inflicts damage, stocks cannot be in a secular bull market. When inflation is under control, it is negative for commodity prices, but good for stocks. There were two major overlaps between stocks and commodity prices, the first from 1942 to 1951. Commodities were in a secular bull market until 1951. Although stocks did not begin a secular bull market in real terms until 1949, the bottom in 1942 was hugely significant as stocks trended higher with little interruption until 1949. The image makes it difficult to see, but some metals prices and mining stocks in the 1960s performed quite well alongside the stock market. We are in the middle of the third overlap. The S&P 500 has continued to make higher highs and new all-time highs. Figure 2.2 shows the Bloomberg Spot Commodity Index, which surpassed its 2008 and 2011 highs in late 2021 onto a new all-time high in early 2022. Gold broke out to a new all-time high in March of 2024. Let me diverge for a moment and circle back to the secular relationship between gold and the S&P 500 U.S. stocks, as discussed at the beginning of this lesson. There is a sharp distinction between the secular trend of each. In Figure 2.3, we can see that the breakout in each market occurred around the time the other market made a secular peak. Note how few the major breakouts in each market occurred soon after the other market made a secular peak. There are several examples. The U.S. stock market's epic breakout in 1982 occurred shortly after gold's historic peak in 1980. The S&P 500 broke out from a 13-year base in 2013, 2 years after gold's epic peak in 2011. Gold's historic move in 1971 began a few years after the S&P 500 peaked at the end of the 1960s. However, months ago, gold broke out to a new all-time high from its super bullish 13-year cup and handle pattern, but the secular bull in the S&P 500 remains intact. This is a major overlap. How do we explain this considering their well-defined inverted secular relationship? Figure 2.4 plus the S&P 500 and Barron's Gold Mining Index, a historical index for gold stocks, silver, and gold. This chart explores the precious metal sector more deeply while explaining the context of the current overlap in secular trends. First, you can see that the precious metals market performed best during the secular bear markets in U.S. stocks, highlighted in yellow. Within the yellow periods, there are periods in which U.S. stocks enjoyed cyclical bull markets. These were periods in which precious metals and U.S. stocks trended together. Those include 1932 to 1937, 1971 to 1973, and 2002 to 2007. The major outlier and overlap in the secular relationship between U.S. stocks and precious metals was the 1960s, during which gold stocks broke out of a 3-decade-long base in late 1964 and enjoyed one of their strongest cyclical advances in history. Similarly, silver also moved to new all-time highs, excluding a pop during the Civil War, but its advance was not as strong. The S&P 500 did not begin a secular bear market until its peak in 1968, but its bull market began to slow considerably in the early 1960s. From its peak at the very end of 1961 to its secular peak at the end of 1968, the S&P 500 gained only 50%, and the Dow Jones Industrial Average, which peaked in 1966, gained only 34%. During those 7 years, the gold stocks gained over 300%. The massive breakout in gold stocks in 1964 equates to the breakout in gold today. See the blue arrows in figure 4.4. Investors could not buy gold until late 1971, so gold stocks in the 1960s functioned as gold does today. From November 1963 to the respective peaks in 1968, the Barron's Gold Mining Index surged 373%, while the S&P 500 gained only 56%. While the current and most recent period has been similar to the 1960s, precious metals have not performed as well as they did then. A major reason is that the U.S. stock market has remained in a secular bull market and has yet to slow down today the way it did after the early 1960s. Another reason is that gold today faces far more competition for investor capital than gold stocks 60 years ago. Investors can buy emerging markets, foreign currencies, dividend ETFs, and tips. None of these options were available 60 years ago. Figure 2.5 is a very important chart as it explains the difference in relative performance between gold stocks in the 1960s and gold today. Note the two lines showing the breakouts in gold stocks in late 1964 and the breakout in gold in March 2024. The gold stocks immediately outperformed the S&P after their breakout in late 1964, and that continued for another 3+ years. While today, gold has risen from a high of 2,100 to recently as high as 2,700, it has struggled to outperform the stock market during that rise. Gold, breaking out of its 13-year cup and handle pattern and surging past 2,100, signals the beginning of a new secular bull market. But this has yet to be confirmed because gold is not outperforming the stock market and the conventional investment portfolio. Side note, as we're recording, this has been confirmed. In figure 2.6, we show what we consider to be the most important chart in gold. We plot gold at the top in a ratio of gold against the total return of the 60/40 conventional investment portfolio. This expounds upon the gold to S&P 500 ratio by showing gold against the total return, including dividends, of a portfolio of 60% stocks and 40% bonds. The blue lines represent the nominal bottom in gold and the start of its breakout moves against the 60/40 portfolio above the red resistance lines. See the blue arrows. The vertical red lines mark the end of the secular bull markets. As we can see, the strongest moves in gold occurred in tandem with gold outperforming the 60/40 portfolio. This makes complete sense, as gold and the 60/40 portfolio compete for investor capital. After the ratio broke above the red lines, the secular bull market in gold continued for another 8 years, 1972 to 1980, and 9 years, 2002 to 2011, respectively. Gold is very close to breaking out of a nearly 10-year-long base against the 60/40 portfolio. If the secular bull market in stocks ends in the next year or two, the ratio could explode higher out of its base, as it did in 1972 and 2002. When I wrote the first version of my book in 2015, my conclusion, which proved to be incorrect, was that the U.S. stock market could be in a secular bear market and that gold would have a blow-off move like the one in the late 1970s to end its secular bull market that began in 2001. In the second version, written in 2019, I realized that U.S. equities were in a secular bull market and that there were quite a few similarities to the 1960s. I continue to hold that view, and the evidence argues that U.S. equities are in the mature phase of a secular bull market that could end within the next few years. Figure 2.7, courtesy of Fidelity's Jury and Timmer, shows a cumulative real return from the S&P 500's 4 secular bull markets of the past 100 years. It is an excellent chart because, unlike a price-only comparison, it includes dividends and is adjusted for inflation. The previous 2 secular bull markets peaked in 2026 and 2028, with the 1966 peak in stocks in 2025 on this scale. Let me step back and explain the driving force behind these major trends so we can understand the causes of secular trends and trend changes. Secular bear markets in equities usually begin with or are caused by extreme overvaluation, very high ownership of stocks, or rising long-term interest rates due to inflation. Policymakers decrease interest rates and increase government spending to combat the negative effects. Lower rates, and particularly declining real interest rates, help counteract recession by reducing the debt burden and encouraging more borrowing and consumption. Increased government spending also picks up the slack. These policies are inflationary and most favorable to gold and hard assets, which are in a supply and demand imbalance due to the preceding secular bear market and years of low capital investment to create future supply. Positive and rising real interest rates signify a healthy economic environment and usually coincide with secular bull markets in equities and often, but not always, in bonds. They keep a lid on inflation but facilitate sustainable growth. Depositors, savers, and lenders can earn a real rate of return while providing capital for productive investment. The economy and financial system are healthy enough to withstand conventional monetary policy during these periods. At lows in the business cycle, policymakers will decrease rates and increase spending, but usually not to the degree seen as recently after COVID, as well as in the 1930s. The trend in inflation mirrors that of commodity prices, and as a result, major turning points in commodity prices and the rate of inflation contribute to secular trend changes. Most notably, major peaks in commodity prices and the inflation rate, such as in 1920, the early 1950s, the early 1980s, and 2011, coincide with troughs in stock market valuations in the start of secular bull markets in stocks. On the other hand, as inflation begins to take hold, as it did in the mid-1930s, mid-1960s, and in the wake of COVID-19, it leads to lower stock valuations and secular bear markets. Figure 2.8 shows the interplay between the stock market, valuation, long-term interest rates, and the rate of inflation. We plot the Dow Jones Industrial Average, CAPE, 10-year PE ratio, courtesy of Yale professor Robert Shiller, the yield on the 10-year Treasury note, and the CPI, Consumer Price Index. The yellow highlights the secular bear markets in U.S. stocks, including 1906 to 1921, 1929 to 1942, 1966 to 1982, and 2000 to 2009. Extremely high valuations, most notably 1929 and 2000, inflation, and rising rates, mid to late 1960s, or a combination, 1906, can be the root cause of a secular bear market. Although valuations are quite high today, CAPE ratio is in the 93rd percentile, the best comparison is to the early 1900s and the mid to late 1960s. The 1929 and 2000 peaks were true bubbles, during which bonds remained in a secular bull market. Long-term rates are rising today, and bonds are in a secular bear market, much like in the mid to late 1960s and early 1900s. The 10-year yield reaching and moving above 5% in 1966 to 1967 is said to have caused that secular peak in U.S. stocks. See the blue arrows. I would not be surprised to see a repeat over the next few years. It is important to note that a secular bear market occurs quietly in an inflationary time such as the present, the late 1960s, or the early 1900s. The market loses value not from a major crash like 1929 or 2000, but from ongoing inflation and lower valuations. From the stock market peak in February 1966 to the peak in December 1972, the S&P 500 gained only 28%, while the CPI gained 33% during the same period. However, the S&P 500's total real return was 4.2% annualized over that nearly 7-year period due to strong dividends, which do not exist today. Current estimates for future returns, as one would expect due to high valuations and heavy ownership of stocks, are in the low single digits. Goldman Sachs published its estimate in October 2024 that the S&P 500 will deliver a total return of 3% per annum and 1% per annum inflation adjusted during the next 10 years. Barry Bannister, the chief equity strategist at Stifel, estimates an inflation-adjusted annual return of 3% over the next 10 years. Savita Subramanian, the chief of equity strategy at Bank of America, estimates a 1% to 2% return per annum over the next 10 years. These estimates all bode very poorly for the S&P 500, as they are even lower when we remove dividends. In Figure 2.9, we plot the S&P 500 along with several data sets: the CAPE ratio, household equity investments as a percentage of all assets, and Professor Shiller's excess CAPE yield, which is an estimate of total real return per annum over the next 10 years. That is presently at 1.83%. Many have observed that the household equity investments have an even stronger inverse correlation to future equity market returns than the CAPE ratio. It is currently at an all-time high, surpassing the peaks in 2000 and 2021. The confirmation signal for a new secular bear market is when the S&P 500 convincingly falls below its 40-month moving average. The blue arrows signal how the stock market remains above the moving average during a secular bull market. The red arrows signal the first major break below the moving average, which all occurred roughly about 12 months after the secular peak. Finally, it is important to note that conventional stocks are not a hedge for a secular inflationary cycle. The modern world of finance does not know or understand this because there has only been one such cycle in the last 100 years. Figure 2.10. In Figure 2.10, we plot an index showing the total real return of the stock market dating back to 1900. The chart includes the rolling 20-year return and rolling 15-year return. The vertical red line marks the start of the four secular bear markets. The inflationary secular bear markets of 1906 to 1921 and 1968 to 1982 ended worse than those of 1929 to 1942 and 2000 to 2009. Stocks can initially rise during a secular inflationary period. Still, persistent inflation eventually eats away at corporate margins, forcing capital into alternative investments and resulting in lower and lower valuations for conventional stocks. Consider the total real return roughly 13 years after each secular peak. After the 1906 and 1968 peaks, the total real return was materially lower. However, 13 years after the 2000 peak, the total real return had already made a new high. In 1942, the total real return was relatively in line with that of 1919 and 1981, but that was only due to the near 90% stock market crash after the 1929 peak. In the latter stages of inflationary secular bear markets, the total real return drops to a level similar to 20 years ago. It made no progress from 1902 to 1921 and from 1906 to 1923. During the 1960s and 1970s, there was no progress from 1962 to 1982 and from 1965 to 1984. No progress during any of those periods. Chapter summary. The secular trend between stocks and commodities and gold alternates. When one is in a secular bull market, the other is in a secular bear market. Rising commodity prices are inflationary and negative for conventional stocks. Major peaks in commodity prices lead to secular bear markets in hard assets in periods of lower inflation, which is very positive for the stock market. The two asset classes can and often will trend together for more multi-year periods. And there is some history of secular trends overlapping. The 1940s is one case of overlap in which the stock market made an epic low in 1942 in the middle of a secular bull market in commodities. Another case of secular overlap was in the 1960s, during which silver trended higher and gold stocks exploded out of a 37-year base in 1964. 28-year base in 1964, 2 years before the peak in the Dow Jones Industrial Average and 4 years before the peak in the S&P 500. We see another such overlap today, which is much like the 1960s. The secular bull market in U.S. stocks continues even as gold broke out of its 13-year cup and handle pattern in March of 2024. Bonds fell into a secular bear market in 1965 and after COVID-19. The secular bull market in U.S. stocks slowed down after the mid-1960s, but did not end until 1968. History, valuations, and household positioning argue the secular bull market in U.S. stocks while likely to continue for another year or two, is in its final innings. The breakout in gold to new all-time highs, coupled with rising inflation expectations and a new secular bear market in bonds, argue that the coming secular bear market will be inflationary and similar to 1968 to 1982 or 1906 to 1921. These secular bears did not begin with crashes like the 1929 to 1942 and 2000 to 2009 periods because bonds were no longer in a secular bull market. An inflationary secular bear market is deceptive because U.S. stocks can initially hold up and perform okay, lulling investors into a false sense of security. As inflation persists, it slowly wreaks havoc on stocks, steadily eroding real value over time. In its latter stages, the total real return index will reach a level showing no progress over the previous 20 years. Figure 2.6 shows two signals for a full secular transition from U.S. stocks to gold. First, as shown in Figure 2.6, gold needs to break out in a way when measured against the total return of the 60-40 portfolio. This occurred in 1972 and 2002, confirming a new secular bull market in gold that lasted another 8 and nearly 10 years, respectively. The second signal is the S&P 500 falling below its 40-month moving average. Side note, we have the breakout against the 60-40 portfolio. We got that. Continued. Chapter 6 will discuss the macroeconomic reasons for higher and persistent inflation. There are several. COVID-19 and the Ukraine war have been major catalysts for reshoring supply chains. Global trade, which increased at a share of GDP from 35% in 1985 to 61% in 2008 and kept a lid on inflation, is now past its peak. According to a Gallup poll, Americans' approval of labor unions is now the highest since 1965. The factors that have contributed to low and stable inflation for decades, increasing globalization, global trade, labor losing power, and economic neoliberalism, are reversing course, impacting corporate profits and record profit margins. That is the end of Lesson 2. In Lesson 3, we will discuss gold's relationship with bonds and currencies. Thank you so much for joining me.